Okay, we are going to take a look at taking withdrawals from a life insurance policy, and then taking loans, and then taking a combination of withdrawals and loans from a life insurance policy. We're going to go through the benefits, we're going to go through the risks, the potential risks that can occur, especially from a taxation standpoint. This is the kind of stuff people are not aware of often. Have you ever heard cash value life insurance is the best place to position your money because it's tax-free, or you can generate a tax-free retirement down the road? And that is 100% true if it is designed properly and executed properly. So important to be aware of this. Let's get into the numbers. So we're going to look at a couple different scenarios here. We've got a policy on a 50-year-old male paying in $500,000 over 5 years. We condensed the funding period, and we can really do this however we want. We can fund it over a longer period of time. The funding doesn't matter here, the income does. That's what we're going to look at. So the first sheet we are going to see here, we're going to look at policy withdrawals only. So I want to see, what does it look like when I take distributions from the policy, but what are the tax implications specifically? So here we've got a policy on the left, 50-year-old male, funding $100,000 per year for 5 years. That's it. Break-even point between years 3 and 4. Cash-rich policy. This is a 1090 split, a little bit more aggressive, but it's a max-funded policy. Minimum premium, minimum insurance expense, maximum juice, cash value. All right. So there's our cash value accruing over time. Looks good. $1 million death benefit gives him a clean $100,000 MEC limit, by the way. So to touch on one of the risks, if he were to take a policy withdrawal in the first 7 years, that would trigger a MEC because he has funded up to the MEC limit during those 7 years. If you fund up to the MEC limit on any one of those 7 years and then take a policy withdrawal, you will run into a MEC. Now, if you actually do this, if you have a policy and this happens, we've had this happen with our clients, one of them in the past, very easy to fix. We get a notification, we say, hey, Mr. Client, we just noticed that you took a withdrawal transaction, it did trigger a MEC. Did you mean to take out a policy loan there? Yeah, I definitely don't want a MEC. No problem. All I need from you is an email, and then I can forward that to the company, and they will reverse the transaction and apply it as a loan instead. So if you do run into a MEC, it is easy to reverse and fix. Good to be aware of that, since the word MEC often is used to scare people. Okay, so now we're going to look at the same policy, but with withdrawals only. So we've got our cost basis here. And why we've put this in here is I want to be able to see how much I paid in and then how much I pulled out total. Meaning, was this a good place to position my money? Safe, liquid, tax-free, all that good stuff, but was it a good place to position my money if income was my goal? Maybe I used it throughout the years, maybe I didn't. I'm focused on income here. Let's look at the income. So we start to take income out at age 65. And we just plugged in $50,000 per year to simplify things here. Okay, so in purple, that's your annual income column. Here's what I want to highlight. Look at age 65. Your cost basis was $500,000 because that's how much you paid in over the 5 years. Then at age 65, you take out your first retirement distribution, $50,000. Your cost basis goes from $500 to $450. This would not trigger any income tax because you're just taking back your principal. And it's a non-MEC policy. So you continue to take your $50,000 distributions. We'll assume you just want $50K per year. You can take them however you want. Here's your cost basis. Pay attention to your cash value and death benefit as well. You see them decreasing. Cash value is decreasing fairly slow because we're earning interest on it as well. That's the nice thing here. I mean, I'm pulling out 50. How much did it drop by? About 15K, about 14K really. Not that much. So that's a good thing. Now, we've got this highlighted at age 75. 74, I've distributed a total of $500,000. This assumes no policy loans in this model, only withdrawals. Okay, 50K comes out. Why we have this highlighted here? Look at my cost basis, negative $50,000. That means I've paid in $500K and I've pulled out $550K at this point in time. So I'm starting to pull out more money than what I've paid in, which is good. That's good news. And I still have a huge bucket of cash value there. The thing to be aware of though, because the title of this Excel workbook was tax implications, at this point in time, if I withdraw beyond my cost basis, this is taxable to you, the policy owner, as income. So if you are living off of $100,000 per year, if you have $100,000 in taxable income, and you pull out another 50 after you've exceeded your cost basis here, that'll be added to your taxable income, and I have to deal with that income tax bill. All of the recommendations or policy tips we give here, anything with the word tax in it, we're not tax advisors or accountants, so it's not formal tax advice. Got to say that. But from a life insurance policy transaction standpoint, this is what would happen here. It is taxable as income. So each year I take these distributions. I'm dealing with tax. Now, I am pulling more out than what I paid in, and hey, this is great. If I look at it over time, look at this. We took income through age 90. I pulled out the $500,000 I paid in, plus another $800,000. $1.3 million in total, and I've got $100,000 left in cash value, about $1.25 in death benefit, and it gradually appreciates over time as well. It starts to slowly come back. You'll never see it continue to depreciate if there's no loan balance here, because whatever I have in the policy, dividends and interest are going to accrue on that, and it kind of is what it is. But what I did here was each time I took these distributions out above and beyond my cost basis, that $800,000, I had to deal with income tax. No one really does this, but it's good to be aware of. The thing is, how do I pull the most money out? So we'll pull the most money out without tax. Let's look at the next sheet. Loans only. So we're not going to look at withdrawals up to our cost basis. We're going to look at policy loans first. So only loans from day one. Okay. Click bigger. Much better. Same thing on the left. That's the same policy, $100,000 for 5 years, optimal cash value. And then we've got this, cost basis, income starting at age 65. Now, when we're taking income here, we are not going to pay the loan interest at all. Often when one is taking retirement, models are run without paying any of the interest out of pocket. It's kind of counterproductive. Why would I take $50,000 and then pay the loan interest out of pocket? You could. There's nothing preventing you from doing that. But if I just say, hey, I'm in retirement, I want my $50,000 and that's it. I want it clean. Don't complicate it for me. Make it simple, Steve. You ever felt like that with any product? I have. So there's my $50,000. All right. Coming out each year. Now, loan interest. The loan interest rate on this is 4.5%. There's my loan balance because I'm not paying anything. The full illustrations and such, we've got these in 2 other areas, or we will be adding them in 2 other areas. One, our agent training program, if you're subscribed to that, and then our membership program, which is available to the public as well. We like to provide more detail as opposed to just Excel sheets. So there's our $50,000 coming out each year. Okay. Loan interest compounds. Loan balance compounds. So let's touch on this actually. Year 25. I pull out $50,000. What does your loan balance grow to though? It grows by, I should say, almost $80,000. The reason why, I've got the $50,000 loan I distribute, that's my money as the policyholder, and then I also have the loan interest, which if I'm not going to pay it, the policy is going to borrow from the cash value and pay it itself. So the annual loan technically for that year when I'm not paying loan interest is what I distribute in a loan plus the loan interest. That's why I see the loan balance compounding over time. Now the cost basis, I still want to track how much I paid in relative to how much I distributed. But here is exactly what I want to touch on. This is the important piece that is neglected at times. Again, we see a lot, or have seen a lot with IUL. I haven't really seen it with whole life, but it can happen with whole life. You know what? Let's not do that yet. There we go. So income up until age 86. And at 86, it goes down from the 50K per year I'm pulling out. Then it's 43, and then you see this big red block. And that gets in my way. And look at your cash value. Really coming down. So what's going on here? Well, what has happened is I have drained the policy. I've pulled out too much cash value at the 50,000 per year pace. I would have to assume a lower income stream here, but pulled out too much. And now what happens is over here on the annual outlay column, you see the product calling for more money, about $30,000 at age 87. 87 years old, do you want to pay that? No, I was looking to pull income out over time. This stuff has to be disclosed to a consumer up front. If you're in the business, make sure you're doing it, run at conservative dividend rate. And if you're not in the business, we want to look for this kind of stuff. Really, our agents should be showing it to us. But this is so, so important. What would happen here, let's assume that at age 87, we said, I don't have the money, like I'm pulling out the 50,000. I can't pay that. Let the thing lapse. I don't want to have to deal with this anymore. If the policy were to lapse with a loan outstanding, here is what would happen. The IRS is going to look at the following. You paid in $500,000, okay? Your distributions, what was the total amount you pulled out? $1,050,000. Where I came up with that figure, right here at age 85, it's actually a little bit more, but I'm gonna look at this benchmark. So I pulled out the $500,000 I paid in, plus another $550,000. I see what I did. So I made it 593 actually. So it'd be 1,093,000 is what I pulled out for a gain of $593,000. So normally the IRS would say, okay, you paid in $500,000, you pulled out, call it just under 1.1, so you've got that gain there of 600K, like if it was with a withdrawal, correct? It's not how it works. I wish it did. This is where life insurance really got a bad rap in the 80s and 90s with universal life, is as that loan balance compounds, that figure is going to be used for an income tax bill. So I've got the loan balance. So when a policy lapses, we took only loans out here, a little under 2 million, call it 1.9, 1.94. Take that, minus the payments you made, your cost basis, about 1.4 million. That's what we would get a taxable bill for, not the $600,000. That's where people can get into big, big trouble with policy loans on cash value life insurance products. Now again, with the whole life, you can project it, you can look at the guarantees and make sure you're safe. IUL is because of all the different assumptions and the things outside of our control, that's where a danger is. Now let's look at the last one. We're almost there. Gotta have fun with this stuff, right? All right. So, same exact policy. On the left, age 50 male, 100,000 per year going in, break even year 3 to 4, looks good. Now, let's look at income, but we're going to look at withdrawing up to my cost basis, then beginning to loan out the rest. All right, here we go. 50K per year coming out. The first 50,000, or the first 500,000, I should say, here's your cost basis, coming down to 0. Then we flip the switch on to continue to take $50,000 per year. but do that through policy loans. Now we're seeing the same thing, the same pattern we just saw with the policy loan assumption, but starting at a later point in time. Because first we took withdrawals up to our cost basis, now we can begin to loan. And by the way, as dividend rates change, as the interest rate environment changes, maybe we add money, pull out less some years, as everything changes, these projections often change too, and you can adjust your course as time passes too. It's not as if whatever we see, hey, it's set it and forget it forever. Now, we do hit that red wall again based off of the $50,000. Not as bad as the last example, but here we go. Cost basis, $500,000. Total distributions, I pulled out the 5 plus another 750, so $1.25 million. That's a gain, if a policy lapses here, of $750,000. However, look at the loan balance when I lapse. That is what I've got to be aware of. So I pulled out $500,000, I recaptured that through withdrawals. So what would happen here, the tax bill, if the policy lapsed, would not be the gain of $750,000 on paper. It would be the $1.1 million loan balance, because the policy was borrowing the loan interest to pay, it was borrowing from itself to pay the loan interest each year. So that's where I can get into trouble there. Again, doesn't happen a whole lot, and if you're working with an agent that knows what he or she is doing, you're fine. The insurance company provides warnings on this. Some of the companies we work with, which I really like, if you have a loan outstanding for more than a year or two, you'll get a message from them saying, hey, heads up, they've got 65% of their total cash value loan from their policy. Have a review meeting with them. We have review meetings with them anyway and go over that kind of stuff. But having the insurance company be proactive and telling the agent that is a really good thing to do, in my opinion, because they're trying to protect their policyholders and not just relying on an agent who may or may not be aware of all this to do the job for them. So hopefully you enjoyed this one. I like going through this stuff. But if you have questions, would like to see any samples, feel free to reach out anytime. And as always, I hope this helps. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.